What if America's most reliable oil supplier suddenly turned to its biggest global rival? For decades, Canada has sent the vast majority of its crude oil south to the U.S., fueling American industries, transportation, and everyday life. But with President Trump's latest round of tariffs, hitting Canadian imports with a 25% duty and energy products with a 10% tax, Canada is reconsidering its loyalties. The newly expanded Trans Mountain Pipeline now gives Canada a powerful alternative: China. With its capacity jumping from 300,000 to 890,000 barrels per day, the door is wide open for Canada to shift its exports eastward, chasing higher profits and reducing its dependence on the U.S. Could this be the beginning of a massive energy realignment? And if Canada does pivot to China, will Trump escalate the trade war even further? Stay tuned as we break down the high-stakes battle that could reshape North American energy and global trade. Canada's energy strategy is undergoing a seismic shift. The expanded Trans Mountain Pipeline, now capable of transporting up to 890,000 barrels per day, has already enabled Canada to explore new markets. Early export data from May to November 2024 show that China purchased approximately 2.03 billion Canadian dollars worth of Canadian crude. This marks a dramatic move, with China now accounting for over 50% of all oil exported via the TMX route. The U.S., historically the dominant market for Canadian oil, now faces uncertainty as Canada diversifies. With a record 4.3 million barrels per day flowing to the U.S., in July 2024, the pressure is on to secure even better terms overseas. This pivot not only challenges long-standing trade ties, but could also force U.S. refineries to scramble for alternatives, potentially driving up energy costs. Imagine the shockwave if Canada slashes its oil exports. The U.S. relies on 4.3 million barrels per day from Canada, 24% of its refinery intake. Such a disruption could easily raise oil prices by $5 to $6 per barrel, hitting consumers hard at the pump and straining U.S. industries. Meanwhile, Canada's economy, which depends on energy revenues to bolster growth, faces its own peril. The Canadian Chamber of Commerce warns that cutting exports could spark a domino effect: rising costs, job losses, and an increased risk of recession. This isn't just a trade dispute. It's a full-blown economic crisis with global repercussions. Back in Canada, the debate is heating up. In Alberta, where oil runs deep, Premier Danielle Smith warns that cutting oil exports could devastate local jobs and industry. The prospect of shifting 4.3 million barrels per day away from the U.S., Canada's largest energy customer, has split opinion. On one side, some provinces see an opportunity to leverage new markets in Asia via the expanded Trans Mountain Pipeline, now at 890,000 barrels per day capacity. On the other, critics fear that breaking long-standing trade ties could spark domestic economic turmoil. Prime Minister Justin Trudeau now faces a delicate balancing act: protect Canadian economic interests without igniting further geopolitical friction. As Canada reassesses its role in a shifting global energy landscape, the internal conflict underscores the complexity of trading oil in a divided nation. Before we dive into the next part, take a moment to hit that like button, and we put our best efforts to create our every single video. If you're enjoying it, subscribe to Global Insight and support our journey to bring you more captivating stories. Now let's keep going. Things are about to get even more exciting. The U.S. isn't taking Canada's potential oil export cuts lightly. With President Trump's 25% tariff on most Canadian imports and a 10% rate on energy, American officials are preparing countermeasures. U.S. refineries, accustomed to 4.3 million barrels per day from Canada, now face the urgent need for alternatives. In response, Washington is ramping up domestic drilling efforts and expanding strategic reserves, while lawmakers debate imposing additional tariffs on Canadian goods to leverage negotiations. Industry experts warn that any disruption in Canadian oil supply could spike fuel prices and ripple through U.S. markets, increasing costs for consumers and manufacturers alike. The battle over energy isn't just about trade, it's a high-stakes game that could reshape North American economic ties. Canada's potential cut in oil exports is set to send shockwaves around the world. With U.S. refineries relying on 24% of their crude from Canada, any disruption could push oil prices up by $5 to $6 per barrel, triggering global inflation. As American industries scramble for alternatives, volatile markets and politically unstable suppliers may gain ground. Meanwhile, Asian buyers, especially China, are poised to benefit from increased access via the Trans-Mountain Pipeline. OPEC and global investors are watching closely as these shifts could redefine international energy trade. Thank you for joining us on this deep dive into Canada's shifting energy strategy and its global ripple effects. The story doesn't end here. There's more to uncover about how trade wars could reshape the future. For the next chapter, check out our video, Canada to Cut Oil Exports to the U.S. in Retaliation for Trump's Tariffs. Click now to continue exploring these unfolding trade dynamics with global insight.